Good afternoon, everybody. Welcome in. Give everybody a few minutes to come on in. Welcome, welcome. Hope everybody's having a great day. All right. I'll give everybody another minute or so to pile in. So, hi, Laxorn. Thanks for joining us. Appreciate it. Anybody wants to check in, tell me where they're from, that'd be great. If you don't, it's okay too. Give everybody a couple more minutes. I know it's kind of short notice. Just posted it a few minutes ago, so. Ah, nice. DC. Are you home because of the shutdown? Hopefully not. Michigan. Oh, no. How can I kick people off from Michigan? Oh, no. Hopefully you're not a Michigan fan. Maybe you're an Ohio State fan living in Michigan, though, Sherman. Oh, no. Hold on. You've told me you're not a Michigan fan. Yeah. You're not BC. No, can't remember. Maybe you are a Michigan fan, Sherman. Not likely. Hey, Rick. Nice to see you, man. Canada. Okay. Headed to Florida. Nice. I was actually going to go play golf today. I'm in East Tennessee, so it's 70 degrees here today. But Monday is supposed to be pretty brutal and cold. So, yeah. Nice. Enjoy Florida. Maybe you're going to Naples or somewhere. All right. Thanks, everybody, for joining us. We'll go ahead and jump right in. If you are new to joining us live, we did a full pre-market prep this morning. You can go back and watch that. Just hit the highlights if you want. Key takeaway heading into today was, and we'll talk about where we're at now, was we saw a bounce yesterday. This is our market trend model. This basically tells us buying versus selling in the overall market. The bounce yesterday was very tepid from an overall from a structure standpoint, as well as what we use for our market trend model. The market trend model just keeps us on the right side of the market. So, this is yesterday's frame here. New lows were still outpacing new highs. Our bolded cumulative tick did rise, so indicating more stocks were being bought, but we're still under what we call our colored ribbon. This is basically the longer look back period. So this tells you that more market participants are selling than buying. And as I discussed about this morning, this is where we call our PTF, or our prone to failure area. When we're under the ribbon, we're likely to sell the bounces until we cross back above the ribbon. And that's usually our stance. And that's pretty much what came to fruition this morning. Early on, we already started closing below those shorter term momentum moving averages. So if you were thinking long, you probably should have started rethinking that, because this is indicating that more selling was happening than buying. And then our filtered cumulative tick really started kicking in around 1030, dropping kind of linear to the downside, 45-degree angle. This is institutions. Texas, nice. Thanks, Tart. This is institutions, a larger market participants, and they were selling. Knoxville, oh, Stoff, send me a DM. Let's talk. I'd love to get together if you're willing. Awesome. Welcome, because that's where I'm at. So, yep. So anyway, more selling than buying on larger market participants. So right away, if you were thinking the bounce was going to continue, or you were positioned that way, this should have started getting you out of your trades very rapidly and very quickly. We'll look at the tick RC. The key takeaway here is our mechanical portfolios were still off, so we were not entering our P-trends or a wheel strategy. Again, as I said, prone to failure when we're under the ribbon. We are more looking to sell the bounces or sell the rips, and that's pretty much what come to fruition. So a couple other of our tools that I was watching this morning early on. One is our vol M command. This to get everybody orientated. This is transactions on the options change and chain and structure. And what we do is we aggregate all those, and then we do a center point of the mass, what we call the centroid. That's the bolded lines. And this gives you an idea of where all market participants are moving, what direction, right? And then we place these dotted lines, which are basically linear fit lines, but it gives you an idea of the trend. And this was SPY. This is very easy to see on SPY. But as you can see, trend is down, right? So market participants are transacting strikes lower and lower and lower. Now, we did start to see some bouncing right around in this area. As you can see, the centroid actually started making a higher high. And those do work on this type of centroid. As you notice, we made a lower low, lower low, lower lower low, all the way down, higher low, however you want it. But now we're actually making a little bit higher high, and we started turning back to the upside a little bit. So what would we need to see into the afternoon to suggest that we're going to at least stall or have a significant bounce? You would need to see both of these centroids basically do an about face, start changing direction, making higher highs. And then we have a rate of change tool. You can see the rate of change here on the numerical values here, but we want to see this rate of changes continuing to stack to the upside. So those would be changing from a negative slope to a positive slope. And you want to see those keep stacking, which means market participants are transacting less out of the money to the downside, transacting more out of the money to the upside. So obviously we could, see the market turn around. Would not be a significant bounce to the upside, obviously. And then a couple other areas I was watching was 6,700 round Livermore level, very important level from a option structure standpoint. So that was extremely important, and we're bouncing off that level now. We do have significant overhead headwinds into 6,750, which we talked about this morning. Review our pre-market prep. I talked about the significant amount of the right-hand plane integral of our net stack command, the charm that was above us, as well as the out of the money puts, in the money puts above us. Those were going to be very difficult to overcome. So those were going to be significant headwinds to price appreciation. And then if we started moving to the downside, we actually had an opportunity to capture significant negative delta. Somebody had asked a question about that. And once we started capturing that significant negative delta to the downside, our book gets shorter as we can capture that negative delta. The dealer book gets longer, and they have to sell the hedge flat because you're capturing more of those out of the money puts are now becoming in the money, and they're having to hedge that. So as of now, net stack command snapshot in time, this is what we're looking at: 6,750 overhead, 6,800 overhead on in the money puts. And you can see the difference in the left-hand plane and right-hand plane integral. We have a ton. That's a trading thought is a ton overhead. And you can just see the differential between the in the money puts and in the money calls overhead. So it's going to be very difficult to move with any significant amount to the upside. That said, 6,750 is where the in the money puts are at on the charm level. So those would be kind of that headwind to the upside, and you see where it's stacked via the gamma as well as the net Vanna. So any bounce to the upside, I'm going to be watching 6,750 and to see if we see some sort of rejection or stalling. And then that will be important into that. Yes, sorry, I need to explain that, Tart. Left-hand plane below spot price, that would include your out of the money puts or in the money calls in the structure. This is where moneyness matters, right? So if you have options below spot price and those are puts, those are obviously out of the money at the moment. If you have calls, those are in the money. The right-hand plane is above spot price. Those would be out of the money calls because you're speculating to the upside, as well as in the money puts because spot price is below those. And again, if those are just pure naked options, right? And then obviously we have structures within there that people are playing verticals and spreads and everything else. But that just from an aggregate standpoint of the net OI of what is above and below spot price. So that gives us an idea of what market participants are, how they're transacting and where they're positioned. And then as the day goes along, how charm and then gamma, if we cross those key levels, how spot price can be affected. And then obviously delta, right? I mean, so that's just the aggregate of the options that are sitting there. So we have a ton of in the money puts overhead. This is where the fear and greed component comes in. Those are deep in the money. Good, copy. Hopefully I explained that simplistic because we all want here, our team at Gamma Edge wants everything to be simple and, not have this this cloud or, a cloak over, how everything is explained. And that's what we try to do. So in the money puts overhead, obviously those are going to be a significant headwind. Those continue to progress continue to grow throughout the day. Obviously, if you're below that level with spot price, right? So this is where the fear and greed component comes in. If I am in the money puts and they're at 6,800 and spot price is well below, I really have no fear of losing any of. Yeah, awesome. Yeah, send me a DM. I have my own personal Twitter X channel too, but I'll get in touch with you. Yeah. So fear and greed component, back to that. Sorry. Obviously, if I'm holding those puts and spot price is way below, I really have no fear of those options contracts going out of the money or losing intrinsic value unless we have a significant bounce. So most of those traders holding those options are probably just going to continue to sit, let them decay for the rest of the day, and just continuing to grab intrinsic, extrinsic value, whatever's left in them, depending on what delta they are, right? And as long as spot price continues to chop around below, there's really no fear of them losing any of their capital, right? So that is the key component to what we talk about, moneyness matters and fear and greed component. So the same thing on the other hand, if you're at the money calls or in the money calls below you, it's the same. Sorry about that. Same process. So hopefully that explains that very well of kind of what we're looking at on the net stack command. So then you would go over to our web app, which is very simple. And then we would look at where the structure is sitting at. Now, net OI does not change throughout the day. Obviously, that's end of day. That's industry standard CBOE, but you can just see we are put dominated completely up and down. And then you see 68,700 here. That's index. So that is a key fulcrum point, sensitivity point of a fear and greed component. And why we probably saw a bounce off of there, I would assume some of those put holders probably took some profit into that lower move into 68,700. And we dropped below the COTMP of 67.15. That COTMP is where all those out of the money puts become in the money. And that's usually a point historically where we see some monetization, and that is that fear and greed component taking over, where people have become to the greed pegged to the max point, and they're like, okay, I'm just going to take some of this off and lock in some profit. And then when the mechanical closing of these contracts happens, that's basically what drives spot price. Some of the puts are closed. Our book gets less negative. We've closed those puts. The dealer book gets more negative. Because they've had to buy back those puts, and then now they have to buy to hedge, and that's what causes the relief bounce in price. Now, the monetization of puts can only drive spot price so far. You have to have out of the money speculation, in the money speculation, continuing to drive spot price. So that's why on significant downtrend days, you'll see those quick bounces back to the upside. That's monetization, but then it's not met with out of the money call buying, me opening call contracts. So that's positive delta in my book, negative delta in the dealer's book, and they have to buy to hedge that negative delta. If it's not met with that out of the money call speculation, it's going to basically stall on each bounce. And that's what we're seeing at the moment. A key thing that we talked about this morning, some of our members were asking about, should they jump in right at the open? Should they wait for some data? And really that depends on what type of trader you are and what your risk profile is. Key component is when we're in a put dominated negative gamma environment, the moves get accentuated due to dealer hedging and just the negative gamma environment. Somebody had asked, well, what wouldn't we see a waterfall event if we got below 6,800? And I said, yes, we could, but that may not be necessarily what happens. I don't want everybody to say, oh, we're dropping below 6,800, huge negative gamma on the net stat command, and we're just going to completely whoosh to the downside and everybody jumps in long. And then you get a quick bounce back to the upside from some possible in-the-money calls or monetization. Everybody jumps out of their zero DT trade, and then the market continues back down, right? So you always have to understand where you're at in the structure, the fear and greed component, and then where those key sensitivity levels are and where price could possibly interact cause a bounce back to the upside. And whether you sit through that, if you're holding 0DT naked, contracts, or if you're going to wait for it to for the opening range to settle out, and then you start breaking those key levels to the downside. So today, it would have been you could have jumped in at the open, but we had multiple other places to get in, and specifically right around this 1030. So you got your first move down. I mean, you could call this the first move down if you want. This was 930. We started settling out. We got the second leg down, right, through those key levels. We're below 67.80. We talked about that one. And then we started dropping below here. And then we got the bounce back to the upside. So more than likely, this was some monetization of put holders. And then we look for the rejection. This is kind of where I feel like this is my best risk reward on a significant trending down day. I want to look for the bounces that are shortable when the market trend model is going to the downside. All the speculation is going to the downside. I'd rather short a bounce than trying to jump in somewhere along this move to the downside, because I really have no good risk reward. So for me, bouncing back up towards the 67.70, which we had pegged at the open, this was right around PGEX to the downside. This provided a great opportunity for a good risk reward trade to short to the downside. Again, if this continued to bounce and tipped back 67, possibly 80, I would have been out of the trade. But again, really small risk reward, nice, really small risk, nice reward to the downside because of all the data that was basically telling us that market participants were continuing to speculate to the downside, and the market trend model was breaking here, and right around here, we started losing the moving averages at 1030. Tick US was already significantly to the downside at 1030, and then we continued to the downside. So preferably, I would rather short the bounces than just trying to jump in a quick move at the open. When this is really emotional, it's the opening range. The book is clearing from market on open orders, from pre-market as well as overnight orders. And I'd like to let that settle out and then see where market participants are really wanting to push the overall market for the day. So hopefully that helps make sense of how we kind of look at the SPX and option structure, and how you look at trades for the day. 67.70 was all the way up here this morning. I can pull up my, hold on, let me pull up my 0DT. So here was 67.70. This was PGEX this morning. Yeah, that bounce short trade early on was good, so I missed it. Oh, yeah, no problem. But this is what I wanted to get at. This was 0DT. This was our pre-market prep that we were going through. And 67.70 was that PGEX to the downside. We lose PGEX, you see what this is met with. I was talking about this 67.75, 67.80 area to a couple members this morning, as well as some people on the live, that this could be a stalling area, right? There's in the money calls here, not much. I get it, right? If you look at the OI, it's very small, half of what the put OI is, but this could be your stalling area or a bounce area, back to the upside if it happens. And if we lose PGEX, then we're entering into a more negative gamma put dominated structure. We're capturing all of these negative deltas. Boom, 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 right? Our book continues to get shorter. These are out of the money. They're now in the money. Moneyness matters. The dealer's going to have to hedge those. And then that's met with the out of the money put speculation, right? Which we saw on our Vol D command, 925, 930. We saw significant volume come in to the downside. Now, we don't know if they were opening or closing puts, but we can do some assumptions of where they were opened at. And we were looking to the downside that most likely we would continue down directionally wise. And once you start capturing these, then that's when you start seeing those dealer adjustment bars. Dealer adjustment bars right through here, you see 67.70, right around here, 67.70, we bounced here back to the upside. And then this was that opportunistic short area. And then you start seeing these dealer adjustment bars. These are basically bars where market makers and dealers are just hedging flat with no respect to price or where they're at within the overall structure. So that's basically what is happening. So anyway, so hopefully that helps everybody. Just wanted to get that out there. So anybody has any questions about that, be happy to help. So yeah, let me know. Cool. Thanks, ET. Appreciate it. Good. I'm watching 6,700, but again, that's just a guesstimate, depending on what market participants are transacting to the downside. It definitely could be, we could go below that. The one thing we're watching is speculation. So, yeah, 6,700, key area to watch to the downside. And then if we bounce back up, 6,750, that'd be that first area that I'd be watching for stalling or rejection. And that is based basically on the web app here, move back up towards 6,750. And just previous area where we're at. So that would be the key areas I'd be watching. So, yep, 6,700, 6,750. So. All right, cool. Thanks, everybody. I got to jump off here. Everybody make it a great afternoon. Again, check out our X and YouTube post, as well as our post-market review, where we go over our tools and how we navigate the option structure for today. So thanks, everybody, for joining us. Make it a great day. Manage risk as always.